Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 21, 2026.
Glad to be here.
Yeah, so today we are doing a deep dive into the daily market briefing, and we're looking at a really deeply fractured economy right now.
Oh, absolutely.
Because if you think about it, you have to imagine a world where, the price of gas is just absolutely crushing the world's biggest retailer.
Right.
But then simultaneously, you have these massive tech companies just casually dropping like billions of dollars to build these physical fortresses around their microchips.
It is wild.
It is, and that is the market you woke up to today. So our mission with this deep dive is to basically synthesize all of this for you. We want to bridge the gap between these massive geopolitical shifts happening across the globe and, the explosive tech earnings happening right in our own backyard.
Exactly, because it is all connected.
It really is. So let's start with the broad market overview. Looking at the major U.S. stock indexes today, specifically the S&P 500, we are seeing a lot of green.
Yeah, quite a bit.
The broader market is definitely pushing higher.
It is moving higher. And the primary catalyst driving that broader market optimism today, it actually has nothing to do with corporate earnings.
Really?
Yeah, or even domestic economic data. The catalyst is, well, it's diplomacy.
Oh, right, the Middle East.
Exactly. Investors are laser focused on these very real hopes for a Middle East peace deal. Specifically, the market is reacting to the framework of a potential U.S.-Iran agreement.
Okay.
And the immediate, real-world ripple effect of that geopolitical optimism is that global oil prices are dropping significantly right now.
Wait, I need to stop you there because I think this is a disconnect for a lot of people.
Sure.
I understand that cheap oil helps, shipping companies or airlines.
Right, the obvious ones.
Yeah, but does a drop in the price of crude really move the needle for, software and tech giants in the S&P 500? Or is this just an emotional market rally based on a positive news headline?
No, it's entirely structural. It's not just emotional at all. Because energy is the foundational input for the entire global economy, right?
Okay. Yeah.
It dictates the cost of manufacturing the servers that run the cloud. It dictates the cost of powering those massive data centers.
Which are extremely power hungry.
Oh, massively.
Yeah.
And it's the cost of every physical good moving through a supply chain. So when crude oil prices drop, inflation expectations drop right along with them.
Oh, I see.
And when inflation cools down, central banks, like the Federal Reserve, they are far less likely to keep interest rates high.
Right, which tech loves.
Exactly. Tech stocks are valued based on their future cash flows, so they become much more attractive when interest rates are stable or ideally falling.
Okay, that makes sense.
So when oil drops, the cost of capital effectively drops with it, and the S&P 500 just has all this room to run.
So it is essentially like a global pressure valve releasing.
Yes, great way to put it.
The cooling of a geopolitical hotspot lowers energy costs, which cools inflation, which then allows the entire market to just take on more risk and sort of breathe easier.
Exactly.
But, while the broader market is riding that macro relief wave, individual tech companies are creating their own micro explosions today.
Well, for sure.
And those explosions are being fueled by a totally different kind of fuel, which is artificial intelligence.
Precisely. We are moving way beyond the point where the S&P 500 just moves as single monolith,
Yeah, it's not just one big block anymore.
Right. We're seeing specific tech and growth stocks skyrocket entirely on their own merit today because they are proving something the market has been waiting for, which is AI monetization.
Finally.
Yeah, we are finally seeing AI actually show up on the bottom line.
Okay, let's unpack this because we have two massive examples in today's briefing. Let's start with Workday.
Yeah, Workday was huge today.
They jumped 14% today. That makes them one of the top gainers across the entire market.
Massive move.
Right. And they issued their earnings report and bumped up their margin forecast, specifically citing strength in artificial intelligence. But I have to challenge this, right? Are we just seeing a lingering AI premium?
What do you mean?
Like where any CEO who repeats the letters A and I during an earnings call gets an automatic, double-digit bump to their stock? Or does a revised margin forecast prove there is real fundamental profitability happening right now?
What's fascinating here is that we are witnessing the exact inflection point where the market stops rewarding hype and actually demands execution.
Okay.
2 years ago, yeah, just announcing an AI research division juiced a stock price.
Right. Everybody was doing it.
Totally.
Yeah.
But today, Wall Street wants the receipts.
Right.
So Workday bumping up their margin forecast, meaning they expect to keep a much larger slice of profit from every dollar they bring in going forward.
Right.
That is the ultimate proof of execution. Because enterprise software is highly competitive.
Yes.
So for Workday to expand their margins, it means their AI tools are either automating their own internal overhead, allowing them to do more with less headcount.
Which saves them money.
Right. Or their AI features are so valuable to their clients that Workday now possesses serious pricing power.
So they can actually charge a premium because the software is doing the work of like a junior human resources or finance team for their clients.
Exactly. It isn't just theoretical anymore. It is a measurable increase in efficiency that translates directly to cash flow.
Wow.
And then, you look at Spotify today.
Yeah, Spotify was wild.
They soared 13%, also a top gainer, right after announcing a major AI music deal with Universal Music Group, UMG, alongside some really positive forward guidance.
And forward guidance basically meaning they are confidently telling Wall Street, hey, here is exactly how much money we expect to make over the next few quarters, and the math looks great.
Exactly.
But how does an AI deal with a record label change the math for Spotify? Aren't they just using, algorithms to recommend playlists?
Oh no, they are moving far beyond just recommendation algorithms. This UMG deal is about building the legal and financial framework to monetize generative AI.
Oh, interesting.
Think about the copyright nightmare of users generating tracks using, like, AI voice clones of Drake or Taylor Swift.
Yeah, that's been a massive issue.
Right, so instead of fighting this endless legal war, Spotify and UMG are creating a system where AI-generated music, if it's authorized by the rights holders, can actually generate royalty revenue.
Oh, wow.
Yeah, they are turning a massive legal liability into a brand new revenue stream.
That's brilliant, honestly.
It really is. That is why their forward guidance is so positive. AI is officially moving out of the R&D department and cementing itself firmly onto the balance sheet.
It is incredible. But, if you are looking at your own portfolio today, this next segment from the briefing is a glaring warning sign.
Yeah, a big one.
Because you cannot just buy the market and assume a rising tide lifts all boats anymore.
No, not at all.
While digital and enterprise software companies like Workday and Spotify are, swimming in AI cash, the physical economy and the everyday consumer is telling a starkly different story today.
Very different.
We really have a deeply divided U.S. economy right now.
It really is a tale of two markets.
Mm-hmm.
The high-margin digital world is thriving, while the physical brick-and-mortar world is fighting an entirely different battle against everyday costs.
Let's talk about Walmart, because they were today's top loser.
Yeah, rough day for them.
They issued a worse-than-expected outlook, and they tied it directly to the burden of high gas prices on the consumer. I see Walmart as the canary in the retail coal mine. If Walmart's outlook is shrinking because it costs too much to fill up a minivan, it means the everyday shopper is being heavily squeezed.
Absolutely.
When your core demographic has to spend an extra $40 at the pump, they aren't grabbing those high-margin impulse items in the checkout aisle.
No, they're cutting back. That is the mechanical reality of retail.
Yeah.
Walmart's customer base is just highly sensitive to fluctuations in discretionary income.
Right.
And gas is a non-negotiable expense. So when it stays high for a prolonged period, the retail sector absorbs the immediate hit.
Yeah, that makes perfect sense.
But what makes today's data so revealing is how we can contrast Walmart's immediate vulnerability with the massive struggles happening in traditional manufacturing.
Okay, like who?
Well, look at the automaker Stellantis. Today, they unveiled a staggering $70 billion turnaround plan.
Wow.
Yeah, aiming for positive cash flow, but not until the year 2027.
$70 billion. That is an unfathomable amount of capital to deploy.
It really is.
And I think it highlights the friction of the physical world, right? Because the software company pushes a code update overnight and it's done.
Exactly.
But Stellantis has to physically retool assembly lines, secure global supply chains for raw materials, and retrain thousands of workers just to turn the ship around.
It perfectly illustrates the immense pressure legacy companies are under. They have to survive the immediate economic squeeze, the exact same one hitting Walmart shoppers,
Right.
while simultaneously funding a massive capital-intensive transition for the future. Operating in the physical economy requires a scale of capital that makes those software margins we talked about look almost frictionless.
Yeah, almost effortless by comparison. And that massive capital expenditure Stellantis is burning through brings us to a critical bottleneck.
Which is,
You cannot execute a $70 billion physical turnaround, and you cannot build the future of AI without navigating federal regulations.
oh, absolutely not.
And this tension, trying to protect the everyday consumer's wallet while trying not to stifle long-term technological growth is exactly what is playing out in Washington right now.
The policy landscape is actively shifting in response to both the consumer squeeze and the AI boom.
Right. And before we get into this, we have to make a really clear point. It is important to note for you listening that the markets don't care about the politics of Washington.
No, they don't.
They care about the math. So when we look at these regulatory updates from the Daily Market Briefing, we aren't looking at this as a political endorsement or taking a side on left-wing or right-wing policies. We are analyzing this purely through the impartial lens of the source material. Like, how do these specific regulatory delays alter the balance sheets and strategic plans of these companies?
That is the only way to look at it from an investment standpoint. We're just looking at the mechanics.
Right, just the mechanics.
So the briefing highlights two major policy delays from the Trump administration today. First, President Trump postponed the signing of an AI executive order.
Okay.
And he specifically cited concerns that implementing it could hinder the development and innovation of artificial intelligence.
Got it.
Second, the administration delayed new EPA rules. Now, the stated claim for this delay is that it will save consumers money at the supermarket, though the briefing explicitly notes that the actual impact on food prices remains entirely unclear.
Right, so that impact is still a question mark, but this raises a fundamental question about market mechanics. Do sudden regulatory delays, even if the stated intention is to spur innovation or lower costs for that squeezed Walmart consumer we talked about, do they actually help the market?
That's the big question.
Or do they just create a holding pattern of uncertainty for a CEO who is trying to plan a 10-year supply chain?
Well, it is the classic double-edged sword of deregulation. In the immediate short term, markets almost always applaud a regulatory delay because it removes an impending compliance cost.
Okay, how so?
Well, if a new EPA standard is delayed, a manufacturing company doesn't have to spend millions retrofitting their exhaust systems tomorrow.
Right.
If an AI safety mandate is postponed, a tech company doesn't have to hire a massive team of compliance lawyers this quarter. That saves cash immediately.
Which instantly makes their operating expenses look much better for the next quarterly earnings call.
Exactly. The short-term numbers look great, but long-term capital allocation requires predictability.
Predictability, right.
If you are a CEO planning a 5-year, multi-billion-dollar infrastructure project, a postponed rule is not a canceled rule.
Oh, that's true. It's just hanging out there.
Right. It leaves a lingering question mark over your head. You don't know what the legal landscape will look like when your project finally launches in 3 years.
Right.
So while the government hitting pause on AI regulation today frees up cash in the short term, it complicates the long-term risk models for companies trying to build the future.
And while Washington hits the pause button, the tech giants are hitting fast forward.
Oh, they're sprinting.
Because they realize that regardless of what the executive orders eventually say, the software revolution cannot happen without physical hardware.
Right.
They are scrambling to secure the chips, the data centers, and the infrastructure required to actually run these massive AI models.
Because unburdened by immediate federal regulations, the biggest players are making massive defensive investments right now.
Very defensive.
They know that whoever controls the physical compute power ultimately controls the future of the digital economy.
Here's where it gets really interesting. Just look at the infrastructure moves happening today in the briefing.
Yeah, there's a lot of them.
Microsoft is currently in talks with Anthropic for an AI chip deal. And this isn't just a casual partnership.
No, not at all.
This comes right on the heels of Microsoft pouring a massive $5 billion investment into them.
Right.
They are actively trying to lock down the compute currency. Then you have NVIDIA, arguably the undisputed king of AI hardware, officially conceding the Chinese AI chip market to Huawei.
Which is huge news.
It's massive. And back here in the U.S., in what looks like a deeply defensive move, Meta, Broadcom, and a coalition of others are launching a $125 million semiconductor research hub at UCLA.
Right, in California.
Yep. Meanwhile, looking up to low Earth orbit, SpaceX is reportedly heavily reliant on Starlink, their satellite network, to drive growth and profitability as they prepare for a highly anticipated NASDAQ listing. I mean, they aren't just building faster software anymore. It's like the 1849 gold rush. But instead of pickaxes and shovels, the modern rush is for semiconductors and satellites.
Yeah, that's a great way to look at it.
It is like they're trying to build the internet all over again, but this time it's private. Meta and Broadcom aren't just building chips at UCLA, they are building a walled garden. Microsoft, Meta, SpaceX, they aren't just looking for gold. They want to own the toll booths on the only highway that leads to AI.
If we connect this to the bigger picture, you are absolutely right about the toll booths, but what is crucial is where those toll booths are being built.
Okay, tell me more.
What we are really witnessing today is the geopolitical fracturing of technology.
Walk me through that. Why does NVIDIA, a company that wants to sell as many chips as humanly possible, willingly concede a market the size of China to a competitor like Huawei?
Because the AI hardware market is no longer a globally free-flowing trade. It's just not. Advanced semiconductors are now viewed by global superpowers as critical national security infrastructure. They are seen as equivalent to nuclear materials or energy grids.
Wow.
So NVIDIA conceding China isn't a failure of marketing on their part. It is a recognition that the hardware supply chain is becoming fiercely regionalized.
Interesting.
And it's restricted based on geopolitical borders and export controls.
So it is essentially the balkanization of the microchip. You are either inside the U.S. allied ecosystem or you are entirely outside of it.
Exactly. And that external fracturing forces domestic alliances that we simply wouldn't have seen a decade ago.
Like the UCLA hub.
Right. That is exactly why you see fierce competitors like Meta teaming up with Broadcom to build that $125 million research hub.
Because they have to.
They recognize that if the global supply of chips can be disrupted by a single geopolitical event or, a new export restriction, then supply chain security is paramount.
Yeah, it's life or death for their business.
They need to ensure they have the intellectual property and the manufacturing capabilities locked down domestically. They are building a physical fortress around their supply chains so their software never goes dark.
And SpaceX fits right into this infrastructure race too, right?
Yeah.
Because Starlink isn't just about providing rural internet to people.
No, not at all.
It is a proprietary global data transmission network in space. If they control the satellites, they control the data pipeline, which makes their upcoming NASDAQ listing incredibly attractive to investors who want to own, like, the physical layer of the future.
Precisely. Whether it is microchips at UCLA or satellites in low Earth orbit, the most valuable tech companies right now are the ones building the physical roads.
Wow. So what does this all mean for you as you navigate this market? We have covered incredible ground today, from international diplomacy all the way down to the micromechanics of Spotify's balance sheet.
We really have.
Let's quickly synthesize the key takeaways from today's deep dive into the daily market briefing. We have 5 major themes for you to track going forward.
Sounds good.
First, AI growth and execution. AI is no longer just a buzzword. It is driving tangible margin expansion. We saw this driving the top gainers today, like Workday and Spotify, and keeping the most active stocks, Microsoft, NVIDIA, and Meta at the absolute center of the trading volume.
Second is semiconductor development.
Yeah.
The physical hardware is becoming the ultimate bottleneck. With geopolitical tensions rising, we are seeing massive localized investments.
Right.
Things like the new UCLA hub and Microsoft's chip deals, all of this is to secure domestic AI infrastructure.
Third is global economic trends. You cannot ignore the macro picture here. The very real hopes for a Middle East peace deal and the resulting decline in global oil prices, they are acting as a massive pressure valve.
Big time.
Cheaper energy is lowering inflation fears, which is heavily dictating broader market stability and pushing the S&P 500 higher.
Fourth, earnings and economic data. The U.S. economy is presenting a deeply mixed bag right now.
Yeah, totally divided.
We have this divided landscape where AI enterprise software is thriving and generating incredible profit margins, while the physical economy and retail, perfectly symbolized by Walmart's downgraded outlook today, are struggling.
Right. Struggling under the weight of high gas prices, squeezing the everyday consumer.
Exactly.
And finally, regulatory developments. We are seeing a federal government in Washington that is hesitant to disrupt the current trajectory. The delayed EPA rules and the postponed AI executive order show an administration choosing short-term deregulation to ease immediate compliance costs. Though, as we discussed, it leaves long-term structural questions hanging in the air for companies trying to plan ahead.
It does. And, as you digest all of this information, this raises an important question to leave you with today.
Okay, let's hear it.
We just spent a lot of time discussing how the physical infrastructure of AI,
Hmm.
the chips, the data centers, is becoming hyper-regionalized and geopolitically restricted.
Yeah.
We see this clearly with NVIDIA having to split from China's Huawei and domestic hubs forming at UCLA. So if the physical hardware that runs the digital world continues to become walled off by national borders, how will that change the historically borderless, open-source nature of global software development over the next decade?
Oh, wow.
Right, like, can a globally open software ecosystem actually survive if it is forced to run on heavily fractured nationalized hardware?
That is a fascinating question to end on. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.